Hello, everyone. Welcome to episode 4 of the Aerial Effects Psychology series. This is part 4 of a 5-part series, and I will be finishing up the series next Thursday, in which I will be releasing episode 5, which will be a recap of everything that has been taught to you over the past 4 weeks throughout this series, and preparing you for more of the complex, more in depth material that will be covered in the Aerial Effects Advanced Psychology course. That will be released on Halloween, so October 31st. And 2 days prior to that, we will be holding a free live webinar for anyone who wants to join. That will be on the 29th. That is a Saturday, and we will be going over everything psychology related, going to be doing a really cool interactive with you all, but you will have to register for that event. I will be posting more information about how to register throughout the coming weeks. So don't worry, you will have plenty of time to join in and get your spot. So be sure to tune into that. That's going to be really, really awesome. I'm very looking forward to that as well. So in this video, I want to talk about and finish up with some of the really just dumb mistakes that people make on a day-to-day basis in trading. And obviously, you could learn a strategy down to a T, but even if you don't have the little tiny minute details figured out, it's going to be very hard on you. So just like, probably many of you have played high school sports, maybe collegiate sports, or even professional sports out there. Your coach should have told you, or probably did tell you, that the little tiny details matter. And it's so true. And even within trading, you can do all the big things correctly, like understanding the strategy, understanding that you shouldn't over leverage, understanding that, specific times of day make probably more sense than other times of day in terms of profitability and probabilities. But like the tiny little details in regards to trading, like understanding the difference between percentages and pips and how taking that knowledge and understanding that pips don't make you money and only percentages do, and focusing your trading around that type of thought process is what's going to really escalate your trading and really produce like 10, 20, 30x returns. And it's so true. If we do the tiny little things correctly, we are going to be so much more better off than every other trader out there. So my goal in this video is to unravel some of the things that a lot of you probably do on a day-to-day basis that can really hinder and cause detrimental effects to your trading. Just the tiny details that we oftentimes don't even know that we do on a day-to-day basis. But it's really important that we make ourselves aware of these so we can focus on these issues and work on them to develop better habits. So I have this picture up here. These were a few trades that we have taken within our VIP community. As you can see, we had a wick entry here. This was on the 5th of October, so last week, last Monday, I believe, or Tuesday. And then this one hit today. We swept liquidity, buy to sell into our level of supply with a nice risk reward here. Now, you just heard me mention risk reward. Now, zooming into this, we first have to understand the difference between pips and risk reward. Now, I'm sure you've heard of the term ROI. ROI stands for return on investment. So, return on investment is calculated using a percent return model, right? So, if I have $100,000 worth of stocks in a portfolio and the portfolio increases to a net value of $125,000, I have netted $25,000 of profit or 25% return on investment. So it's the same thing with any other investment vehicle, any other investment that you make, and specifically in relation to trading. It doesn't come down to basis points, or it doesn't come down to pips, or it doesn't come down to anything else. What really truly matters is the percent return you have on your trade. The reason for this is that when you go based upon pips, you're using an abnormal risk threshold. Your risk is not going to be consistent over time. It's going to be different. And we know that in trading, trading is supposed to be boring. Why? Because it's supposed to be repetitive. We're supposed to be looking for the same things, doing things consistently every single time. And the second we start to deviate from that, that's when it all bellies up. So with this example here, I have a 65 pip stop loss. So if someone, most retail traders probably want to be trading with multiple standard lots on their measly little $500, $1,000 account, which doesn't mean anything, right? But they don't understand proper risk because they're basing it upon pips. So if you're using a standard lot every time, if you have a 65 pips, $10 a pip is one standard lot. That's $650. If you have $1,000 account, you just lost 65% of your account on one trade. You do that again, you blow your account. And the whole cycle continues. You make a little money, then you lose it all again to the market. You make a little bit, you lose it all again. We have to remain consistent in our risk. In order to do that, it comes down to the percentage return per trade and not necessarily the amount of pips, right? So many people would say, oh, 65 pips, or even in this case, what we took, 128 pips. Most people wouldn't even place that trade because it's 128 pips worth of risk. And they're thinking in the back of their minds, well, if I place, I don't know, a 0.1 on this, I lose $128 out of my measly little $300 account. And that's almost 50% of a loss. Well, you're not supposed to be risking a 0.1 on a $300 account with 128 pips, right? That's how you blow accounts very quickly. But in all reality, I love this trade, even if it's 128 pips, because it's a 1 to 5.42 risk to reward. Meaning, if I win this trade, which I'm probably going to, then I will make 5.42% return on my account. So it's not the pips that matter, it's the percentages. And let me just give you a little bit more of an example. So I'm going to clone this here, and I'm going to just put this over here as a reference. So let's bring this all the way up. I'll show you. So right in here, we're going to go 200 pips, okay? 200 pips there, and we're going to have a stop loss of 100 pips. So many people think, oh, 100 pips is really, really bad. Well, it may not be that bad, okay? Because someone else may have, again, maybe like, let's say 100 pips, right? They look for 100 pips. And in this case, they may have like 80 pips of stop loss because maybe their percentage return goals are different. Maybe someone wants 100 pips and they get out, someone wants 200 and get out, even though this person has a less of a stop loss, this person has more. So naturally people think this person is going to lose a lot more money than this person because their stop loss is bigger, but in all reality, this person made more money because they had a bigger risk to reward. Same goes for if you have a larger return, right? If you have a larger return with, let's say, 100 pip stop loss, okay, and you go for 300 pips, okay, now this person made 300 pips worth of profit. But let's just say that I had a 50 pip stop loss, okay, and then maybe a, 200 pip return. In this case, this person made 100 more pips than I did, but I made more money than they did because it's a percent return on account. It doesn't have anything to do with your risk, right? Or it has everything to do with your risk to reward and not anything to do with your pips. So in this case, I made less amount of pips than this person, but yet I made more money than they did. So many people come to me and they're like, oh, I made 500 pips this week. And I tell them, oh, cool, I made 200 pips this week. And they're like, oh, I made more money than you did. That's not always the case. Just because you made more pips than I did doesn't mean you make more money because it comes down to your risk to reward per trade. Obviously, the lower the lot size or the lower the stop loss you have, the larger the risk to reward you have. Obviously, the more money you could make for that trade. Obviously, the stop loss has to be appropriate. I wouldn't set this stop loss right here, on my most recent trade, right, 65 pips to five pip stop loss because I want a 1 to 100 risk to reward. It's not about what you want, it's about what the market is showing you. So in this case, I needed a 65 pip stop loss because this was the most recent supply level. This is the high of the most recent supply level. So the most appropriate position to place the stop is right above this high. Same thing with this one. I enter at this supply level, I put my stop above the swing high. The supply is high. This happened to be 80 pips. And this one just so happened to be 128. However, I understand that pips don't make you money. It's all about percentages. So what percent return did I do for these trades? So far, I'm aiming for a 1 to 5.4. 5.4% on a trade is very, very good. This one, I'm aiming for a 1 to 7.85. So 7.85% is really good. Currently, I am sitting at 3.75% return. That's a phenomenal return so far. This is a 7.7% risk. Obviously, this one didn't hit. Excuse me. This one didn't hit because we never pulled up that far, but we get the kind of concept. It doesn't matter how many pips you have. It matters about what percent return you have. Because someone else could go like, okay, I don't want any more than a 20 pip stop loss. Let's get rid of this. I don't want more than a 20 pip stop loss, and I'm aiming for 10 pips and dip, right? 10 pips right there. On something other than GJ, it would look a lot bigger, but GJ just pumps pips, which is also another thing that goes to show so many people want to trade stuff like NASDAQ and US 30 and GJ and GBP and ZE, all these pairs because it pumps pips. It moves a lot of pips. But at the same time, it could also move a ton of pips against you. So just because you could make on this particular trade almost 700 pips, it could easily go 128 pips against you. So it's still proportional versus your take profit and your stop loss. It's not that you make more pips with this and then make less pips in your stop. It's the same amount. It's pumps pips if it goes in your correct direction, but pumps pips as it goes in the opposite direction, which is why, since they're proportional, you need an appropriate risk lot size to use based upon your account balance to understand that if you get hit out at 128 pips, you only lose X percent of your account, like 1%. That's my rule of thumb. So in this case, if you use that low of a lot size, which many people will think, oh, a 0.01, 0.02 is too low. But again, you're looking at it from a risk standpoint and a pip standpoint. Look at it from a percent return standpoint now. If you use that low of a lot size, it's still okay because the amount of pips that you're getting is a lot because your risk to reward is a lot. So it doesn't matter how many pips you're trying to aim for. Many people will be like, okay, 1 to 10, or 10 pips and dip type of thing. Oh, I have a 20 pip stop. 20 pips is within my range. This is only a 1 to 1/2 risk to reward. If you risk 1%, you win 0.5%. This is a terrible risk to reward, which is why many people, they go for the 10 pips and dip because it's easy. It's because they're lazy. It's because they don't understand how to trade or where to place their take profits or their stop losses. So let's think about it like this. With 10 pips and dip, with something like GJ, let's go 50 pips and dip. Okay, so this is a 50 pip and dip type of thing. Oops, excuse me. Let me move that stop loss back. 50 pips and dip. So in this case, here's my pip. There it is. People who go 50 pips and dip, it's only this much, right? This is nothing compared to GJ. 50 pips and dip, nothing. Now, to pretty much give you a 99.9% chance of winning this trade every single time, you need to account for all liquidation zones. So we have a liquidation zone here. We have a liquidation zone there. If we go to the higher time frame, we have a liquidation zone there. And let's just extend this all the way up, and let's give it a couple hundred pips just in case it comes all the way up here before it comes back down, right? So in this case, you're risking 700 or 650 pips to make 50 pips because you just want the quick 50 pips and dip. Given that you're probably going to win 99% of the time, what happens that one time that you lose this trade? It just goes against you because some markets, especially in the latter half of the year, like towards like September, October time, tend to move very strongly and without much pullback. So we could see this and this and then this, and then all of a sudden that one time out of 1,000 trades that you've taken, 999 could be winners, but then that one time you lose everything, right? Because you didn't understand risk and your lot size to use because you're just going based upon a pip value and you're going based upon like a 10 pips and dip, 50 pips and dip, whatever you want, right? That's not how trading works. Trading is supposed to work by first understanding your entry points, okay? I'm not going to go over the strategy here in this video, but this was our entry point. Where is the most appropriate stop loss? The most appropriate stop loss after this lower time frame breakout structure within our objective is right above this high, which is why we have 128 pips. But where is my take profit? This is where you need to understand where could price potentially reverse from you. Are you in a higher time frame range? Are you in a lower time frame trend? Are you in a higher time frame trend? Are you in a lower time frame range? Higher time frame? What are you in? And where is price going to go? What is its overall objective? So if we understand where the objective is, since technically we are still bullish on the higher time frame, even with this huge sell-off, if we just zoom out, you can see that clearly, then we would know that price has the potential to react, come down into our levels of demand and go long again. If it goes short, great, whatever. But how do we know it's going to continue short? You can take partials here and hold runners, sure. But if you want to just take profit here, you need to understand where price could potentially reverse from you. And that comes down to 157.5. So with this, we have a 1 to 5.42 risk to reward. And in this case, 5.42% return is very, very good. And it's feasible to attain consistently, right? Another one is, like I said, no stop loss. I believe there was someone on my live session who says stop losses are a scam. Stop losses don't matter. Okay, buddy. How about we don't have a stop loss here, okay? And we enter into a short here. Well, it's okay. Price is starting to go against us. Oh, it's bound to go short eventually. Okay, fine. Let's look at the higher time frame. Let's look at the weekly. What happens if you catch a bottom or you catch a top, or even if you catch in the middle of this range here, goes in the opposite direction, you try to buy here, guess what happens? Now you're almost 4,000 pips against you. Do you think that 4,000 pips with whatever kind of lot size that you're using, you're still going to be able to be in that trade and sustain with the account balance you have? And I'm just talking in general here. Absolutely not. So we can't not have a stop loss. That is so unprofessional. You will blow your account over time. Fine. You may last a year, 2 years, 5 years, and you may get lucky not having a stop because it just ranges higher time frame and it always comes back to your level eventually. But you're holding the trade for months. Sure, that's a possibility. But what happens that one time where it goes against you and it doesn't come back? Let's say you're trading up in here. Oh, you can't lose. You're buying. You got to continue. And boom, you buy it right there. Guess what happens when you don't have a stop loss? Boom, 6,400 pips against you. You're not going to survive 6,400 pips with whatever lot size you have. That's just not feasible. So unless you're using 0.01s, which I guarantee you not a lot of people are doing with their trading, it's just not, they're just not doing it because most people tend to over leverage. So even with a 0.01, 6,400 pips is $640. That's still 64% of your $1,000 account, which $1,000 account for most traders is quite a lot. So that in and of itself, it's not professional. It's not sustainable. We always have to use a stop loss. So with a stop loss, we have to know where an appropriate position to place it. With that position, we have to be able to say, okay, what's my return that I think is feasible for this trade, and does it provide me with a good percent return? If it provides me with a good percent return, I should take it. If not, I shouldn't. Regardless of if this is 200 pips, let's say it's 200 pips. Many people think 200 pips is great, but a 1 to 1.58 risk to reward is not a good risk to reward. It's just not, because it requires your profitability and your win rate to increase. See, I can lose the majority of my trades and still be profitable because I have high risk to rewards. So if I have between a 1.5 and a 1.7 risk to reward every time, so that's the average of that is 6, right? So 1 to 6, that means I can lose 5 trades in a row, then win the 6th trade and still be profitable over time. But people don't take into consideration risk to reward and percent return. And that's why in their trading, because they don't do that, they're required to win more trades than they lose, which in this industry is very, very difficult to do. 50% win rate is still a very, very good win rate to have. That is a phenomenal win rate. I would take that any day of the week because you just need a 1 to 2 risk to reward to break even, right? So higher the risk to reward, the better. But we have to think about it in terms of percentages and not about pips, okay? Because the second we talk about pips, that leads to you placing a trade that has nothing to do with risk. Then that leads to you seeing that go into drawdown, and now you're seeing your $1,000 account go from -100 to -200 to -300, -400, and now all of a sudden it's starting to build up, and then your emotions get to you, and then you lose the trade, or maybe you pull out early, or maybe you even move your stop loss altogether to try to hope that that goes back in your favor, and now you're letting your emotions get to you, and now you've blown your account because you were stupid. So it's the little things that we have to do correctly in order to be profitable. And all this stuff that I'm telling you just leads into a whole domino effect of other problems. If we don't use a stop loss, or if we use a stop loss, but we over leverage on a trade, then you lose that trade. That can lead to revenge trading. It can lead to blown accounts. It can lead to frustration. It can lead to funding a new account just to try to flip that account to get your losses back. It can lead to over trading. It could lead to, so many different things that may not even relate to the problem at hand, but it's a whole domino effect because it's affecting your own mind. That's why trading is 80% of your profitability and 20% is just your strategy. All right. Now, in regard to the money, now this is where it gets interesting. Many people, and I would say probably 75 to 80% of traders out there, trade because of the monetary amount that it provides. So if I have a $100 account, okay, I have a $100 account, and I risk 1% on this. 1% of $100 is $1. And I have a 1 to 3 risk to reward. Great. I've made $3. How many people do you think are satisfied with $3? Probably not anybody. They want to be making $20 a trade, $30, $50, or even $100 a trade. So they over leverage. And that when they over leverage, that's essentially saying if you don't win, you're probably not going to, you're going to get margin called, essentially, if you don't win. So maybe they risk $20 per trade. So now they've lost $20 when they lost that trade. Now they're 20% down in the hole. Okay, let's look at it from this standpoint. If I have $1 million, boom, $1 million. If I'm risking 1%, that's $10,000, right? If I make a 1 to 3, I make $30,000. How many people do you think would be ecstatic about $30,000 gain? Awesome return, right? Now, what if they applied the same principle here to this above account balance? So now, in this case, they wanted to risk $20, right? Because they wanted to make more money. In all reality, this is 20% risk. Now let's risk 20% of this. If they lose that trade, they just lost close to $500,000. They lost $200,000. What kind of emotions do you think will be running through your mind if you lost $200,000 in one particular trade? You applied the same risk. You just thought about it in terms of a monetary amount instead of a percent return amount or a percentage based amount. Now, what if you risk $10,000 and now you're up $5,000? You're up $5,000. You're like, wow, $5,000. I've never seen that amount of money in my life. I have to take my profit. So you take your profit of $5,000. In all reality, that's 0.5%. And now, if you lose the next trade, now you're down $10,000. So now you're down double of what you made before because you were thinking about it in terms of a monetary standpoint. You've made $5,000. Oh, that's the most amount of money ever. Phenomenal. Cool. But if it's not based upon percentages, you're going to lose in the long term. Why? Because if you're risking 10,000 and you make $5,000, that's a 0.5% return. Now, let's say the next trade you take, you lose. Now you're in the whole $5,000. And now that is going to lead to a multitude of other problems, over leveraging, over trading, just so many different things. That's just going to create that domino effect in your trading. We need to be able to treat a $100 account like we treat a $1 million account or a $10 million account or a $100 million account. And it comes with practice, but it comes by understanding that pips do not make you money and percentages for one do, but we can't let the monetary amount affect our decision making. Great, 1 to 3 risk to reward here. You risked 10,000, you made 30,000. $30,000 is a lot of money, but it's only a 1 to 3 risk to reward, which is still a good risk to reward, right? So in this case, if I win this trade of a 1 to 5, I would make, well, in this case 5.4, I would make $54,000. If I lost, I would lose 10,000. But if I was let my emotions get to me and I saw $5,000 go to 10,000, go to 15, and then it starts to drop, you don't want to lose $15,000. You don't want to lose $10,000. So you move stop to break even too quickly. You take partials, you take the whole position out, and then maybe you're stuck closing your position at a 1-to-1 every time, which in turn requires you to maintain a win rate of at least 50% to break even, which 50% professionally in a professional market trading it is very, very good and very hard to attain consistently over a long period of time, which is why most traders lose. So you have to think about it in terms of your account balance, right? And using that with percent return. Okay, let me give you one more example here. So because everyone responds based upon a dollar amount, It goes the same way for Forex mentorship. Let me give you a little bit of an idea of what I mean by this. Forex mentorship, there's a guy, okay? He's driving his little Toyota Accord or a Honda Accord, right? This is a terrible drawing. I'm not an artist. You can laugh if you want. You probably are. That's okay. Toyota Accord. Then you have this guy with a sports car. Ooh, maybe like a Hummer or limo or something like that. I have no idea. It looks like a turtle. Yeah, I'm kind of laughing myself. Anyways, we're gonna call this one. We're gonna call this one Lamborghini. Okay, Lamborghini. Cool. We're gonna call this one Toyota. And I have nothing against Toyotas. Toyotas are cool. But when you see people flashing a Toyota, you're not going to blink twice, right? You're just going to move on with the rest of your day. You see someone flash a Lamborghini, all of a sudden, now you're joining their group, now you're signing up for their course, now you're just blowing up their phone, being like, bro, how do you do this? How do you teach me this? Teach me that. How is them showing you a Lamborghini going to improve your trading? It doesn't relate at all. But you associate a Lamborghini with someone who is a professional trader, which you could assume that they probably make a lot of money trading potentially, but it doesn't mean that they're actually a good trader. It just shows you that they have a Lamborghini. Could their daddy have bought the Lamborghini for them? Could they have won the lottery, gotten lucky? Could they have borrowed it from a friend? Could they have rented it out, which so many people on the internet do? They rent these Lambos out and then they go make these videos, which is absolutely absurd. But anyways, more people are likely to respond, meaning join people's groups because they have Lamborghinis. Now, how does this tie into my whole point here? It ties into my whole point because now let's take it in front of a risk to reward standpoint with account balance. This guy over here, Toyota, he has $1,000 account. Okay. And he risks 1% on this account. 1% risk of $1,000, $10. And he makes a 1 to 4 risk to reward, 4% return, which is what? $40. 4% return on this trade, very good. Give it a check mark. Now, this guy over here has a $1 million account. So he has quite a bit of money. But now in his group, he risks 1%. He risks the same. So that's $10,000 per trade. And now he's made, let's say, a 1 to 2 risk to reward. So he's made 2% return. So plus 2%. Now he's made $20,000. This person has made a lot of money. 2%, I'm going to give it an okay. I'm going to give it an okay. Neither check nor X, right? Just an okay. So when you see on social media someone posting a $40 profit with a $1,000 account balance, if they risk $10, you're going to be like, okay, good for you. Congrats, $40, woohoo. Like, go buy lunch. Now you see someone who has $1 million account and they made $20,000 in a trade. You are psychologically more enticed to want to know more about what that trader does and how they can help you, and you buy their course, join their mentorship, whatever it is that you do, because you're more enticed because you see $20,000, because in your eyes, in a monetary amount, that is a tremendous amount of money. But in all reality, this person right here made more percent return than this person did. This person made more money, right, because they have a higher account balance. But this person made more percent return. I would much rather trust this person to manage my money than this person to. Because this person, it's going to require them a higher win rate to make money because their risk to rewards are lower. This person could lose 3 trades in a row, win the 4th, and still pocket 1%. This person only can win 1 trade or lose 1 trade in a row before they have to turn around and win the next one to break even, because they're only 2% return, 1 to 2 risk to reward traders. So be careful by who you're enticed to in social media, but also pay attention to how that can apply to your everyday trading. Why are people more likely to maybe follow a guy who has a Lamborghini versus a guy who has a Toyota? Because it's a Lamborghini. I get it. But how is that helping you? It's not. Same thing with trading. More people are more likely to follow someone who's making $20,000 profits, even though the percent return could be a lot less than someone who has made $40. Now, okay, let's just say this. Let's just say that now I give this person $1,000,000. Boom. He's made the same percent return. Now that return comes out to 40 grand. Oh, now you're so inclined to see what this guy has going on, the guy with the Toyota. Because now he's made 40 grand, because you're psychologically driven based upon a monetary value. And you don't think in terms of a percent return value. The second you take a step back and you understand pips don't make you money, percent return does. Risk to reward does. The higher the risk to reward you have, the better. More consistent returns with higher risk to reward are going to produce a lot of money for you. That is why, so what if you don't have $1,000,000 right now? Most of you don't, and that's okay. I don't even have $1,000,000 right now. I'm close, but I don't. But I know that once I do, I can be making the same percent return and be making more money. I would rather have someone trade me $100. If someone came to me and traded $100, risking 1% return, and made me $20, that's 20% return over the course of, let's just say, like a year. But then someone else comes to me with $1,000,000 and they say, oh, I've turned that $1,000,000 into $20,000. Boom, I've made more money than the guy who made $20. But you've only made 2% and the other guy made 20%. So I give that guy $1,000,000 who made 20%, and now he's turning my 100 grand into 200 grand. Now this guy is sitting here with 20 grand when this other guy is sitting here with 200. It's all about understanding the fundamentals, practicing, using proper habits so that when you can grow your account over time, even become funded, then you're able to tackle these problems without any issue, right? You're able to face everything here and understand that it all comes down to just numbers. It just comes down to percent return. It comes down to risk to reward. It comes down to percentages and ROI. It has nothing to do with pips. It has nothing to do with monetary value, because everything is proportional. That's what the problem is with all of these prop firm challenges, is that you're so used to trading with $100, $200, maybe $1,000, maybe even $5 grand, who knows? But then you go for a 100K account or a 200K challenge, whatever. Let's just say you pass it. So now you have 200K. Let's just say you are properly using good risk management. 1% of 100 grand is $1,000. So you risk $1,000 per trade. Now your trade is up a 1 to 2, right? Now you can see a floating profit of $2,000. Now you get nervous. Now you start to sweat. Now you're like, oh my gosh, I can't lose this money. Price starts to go against you now. Now it's down to 1,800, 1,700, 1,600, 1,500, 1,400, 13, 12, 11, 1,000. Now you close out of the $1,000 because you were so emotionally driven by that $2,000 return, because it was a lot of money to you in a monetary amount, that you close with $1,000. That's only a 1-to-1. But with your $100 account or $1,000 account, let's just say, you see that go from $10 to 20 to 30 to 40, and you don't even bat an eye. You're like, okay, I'm going to close when it gets to $100 because that's what I want to make. $100 on a $1,000 account is 10%. But you have a $100,000 prop firm account. 10% of that is $10,000. But then you were scared when price was going against you when you were only in $2,000 worth of profit. You see how that doesn't make sense? Because you're emotionally driven based upon the monetary amount, based upon the account size that you have. And that's just saying you're using good risk management in the first place. This is what I mean by taking something very simple and complicating it by not doing the right things. You're doing the tiny little, making these dumb mistakes, even if you're using good risk management. I'm not even saying if you weren't using good risk management. I'm saying if you are using good risk management, you can still face problems just like this. Just like this. You can still face problems just like this. And this is what kills traders, because they don't take the time to do the little things correctly, and it is detrimental to their account. So they wonder why they're losing, and they wonder why they're inconsistent. Even if they think they're doing everything right and they're still losing, they still don't know why. And it's because of these tiny little things that can impact your trading. And then that leads to a whole other domino effect of moving around from group to group, strategy to strategy, thinking it's other people that's wrong, or the strategy that's wrong. Why are you so quick to blame other people for your failures? And you can't understand that it's not the strategy, or it's not the mentor, it's not the group that's wrong. It's probably just you who hasn't put in the amount of energy or effort or focus or experience to make it work for you because you don't learn the little things or don't care to learn the little things because you're so tied up in trying to do what you want to do. And you think that doing the same thing that you're used to is going to somehow change. How does that make sense? People so often do the same thing over and over and over again and expect different results. You keep doing the same thing, you're going to get the same result. That's just how everything works. You're not going to get a different result, right? So if you understand how trading works in terms of its repetition and consistency, we need to be doing even the tiniest little things consistently. Because when we get pips involved, or we are emotional when it comes down to the monetary amount based upon our account size, then that's when everything can start to domino effect in the opposite direction of where we want to go. All right. So I appreciate your time today. Guys, I know this was a terrible drawing, so you can, send me messages and memes or whatever and laugh all you want. I probably deserve it, but hope you guys took some value from this. My overall goal is not to come across as a jerk. It's me to not sugarcoat anything, but to give you the facts, give you straight up what has affected me in my trading, what is actually real in this industry, what people actually go through. Maybe you didn't even know that you do this. Hopefully, I was able to open your eyes to see the bigger picture here. But the only way that you're going to grow is if I give you everything straight up, and I don't sugarcoat anything. I don't be nice about anything. I give you the facts and I tell you what you're doing wrong. And that way you can actually learn and fix the problem so that you can become profitable, which is my overall goal for you, so that you can make a lot of money in this industry. Because there is money, there is enough for everyone. You just got to claim your piece of the pie. All right, so quick reminder, we have that webinar on 29th of October. Stay tuned for that. You have to register. I will be sending out more information as we go throughout the next couple of weeks. This was the last video in the Aerial Effects Site course because next week's video will be episode 5, which is just tying everything together. And it's still going to be really good because it's going to give you, just one video really tying everything together, holistic understanding of really just the basic components, the introductory sort of concepts, kind of surface level. It's still very much valuable. I hope you've enjoyed this series. This is all just surface level stuff, but it's going to help prepare you for the more advanced, more complex, in-depth material that the course will offer you. But what we want is we want you to be able to take advantage of that. So all members who are currently involved in our all-inclusive program mentorship package, you guys will be receiving that course for free. It's on the house. That's all for free for you. If you're not a part of our mentorship and you wish to join, by all means, we still have our promo deal going on. Feel free to hop over to our website, aerialeffectstrading.com, to book a free call to make sure that we are the right fit for you. Would love to speak with you regarding your goals, how we can best formulate a plan of action for you specifically to eventually reach those goals over time. That is what our goal is. We have prided ourselves on that for quite some time, as we have been able to help a lot of clients reach their full potential, which I'm so glad and so proud to see many of you people succeeding with this. So keep up the hard work. But at the same time, if it's not the right fit for you, then at least you know. But you can never know without scheduling a call. And we provide you with our full trading plan and beginner's course absolutely for free as a thank you for signing up. So that course will be released October 31st. But if those of you who are not a part of our VIP still wish to purchase it, we are allowing that course to be purchased on its own. And we will be running a huge Halloween special for a promo for you guys who are the first time buyers with that. So thank you guys so much for your time, and we will see you all on next week's video. Take care.